This paper is about attention directing analytical review using accounting ratios, a case study. Briefly speaking, this article is about a case study of use directing analytic review procedures to apply to several ratios. In this paper, we will use 3 different investigation rules, and we will use them to study different material accounting errors of different types. After they do the test, they find the result that it's very important to know the relative size of the accounting error, and they find that the error is material to year-end financial statements may not be relative to natural variation in 3 or 4 monthly ratio tested, which is row 1 method, the traditional method. They find that what we need is that we need to find the disaggregated base data, and we need to care in defining unexpected relationships. And I think that there may be potential to find the usefulness of considering of deviations in several ratios. In this paper, they try to define the type of error by compare pattern of observed changes in several ratios to changes that would be expected given a particular type of error. The introduction part, we talked first about the background of this kind of study, as many articles already presented today. It's like analysis of ratios of account balance is widely applied to attention directing procedures. However, little is known of the ability of ratio analysis to identify material monetary error in actual accounting data. So it's desirable that we can conduct such analysis over many firms as well as several time periods. First, we want to obtain the reasonable disaggregated data. We think that after we get that, we can do further study. However, we know that in reality, it will be very difficult to obtain that. Therefore, in this paper, it's only used a single firm for over 4 auditor years. First, we want to talk a little about how this paper measures as materiality. Here is the formula. We can see that. I want to explain that the 1.08 is the expected sales growth rate. I will explain more details in the next slide. We want to seeding a material amount for a single error test. We think it may seem excessive, but it seems unreasonable to expect attention directing analytical techniques to correctly identify very small errors. This analysis will illustrate a best case for detecting an error just large enough to be material. Here is how we calculate this expectation. In this paper, the monthly ratio for the sample firm is compared with the data from its own past, adjust for the median change for the firm's industry. In this paper, a reasonable expectation for the value of a ratio in months T is assumed to be the average audited value of the same ratio for the previous audited year, adjusted for changes in the industry. Okay, now we go to the most important part, which is the ratio. We know that here in this paper, we select account balance related to the basic purchasing and sales circle of the wholesaling firms that are used. We want to make sure that the ratios are selected on the basis of the ability of a ratio to reflect the changes due to error types. Of course, there are other ratios. However, we see that other ratios, they combine several accounts. So there will be of little use when we want to use them to indicate the error in a particular account. So here are the four ratios we will use. They are receivable turnover, inventory turnover, cost of sales ratio, and accruals ratio. We know that the first two ratios relate an income statement account to a balance sheet account, and the third ratio relates to income state account. The last one, it relates one balance sheet account to another. I think it can reflect at least four types of event measures the liquidity. Here is the result when we try to check the standard deviation and mean. We can see that there is a relatively little natural variations in the cost of sales ratios. There is little. And there is a relatively large variation in inventory turnover here. I think this follows from the fact that the amount considered material is often quite small relative to a particular account balance, especially for annual balances. Thus, the analysis of annual change cannot be expected to indicate errors from more than material account amount. In this page, we will explain a little about the error conditions. We know that in the following analysis, we will have two types of errors, which is I mentioned in the abstract part, which we want to test. They are purchased on account but not recorded, and fixtures sales on account record. Here are how they will reflect on the ratios. For example, we can see that if there is an omitted credit purchase, there will be a decrease in the inventory turnover, decrease cost of sales, and increase accruals. If there are fixtures credit sales entered, there will be increase in the receivable turnovers and a decrease in cost of sales and an increase in accruals. When we try to design how we will use the investigate rules, we always have a dilemma, which is the simplicity versus accuracy. So in this paper, they will compare three different rules. The first one is the percentage change rules, which is very simple, and a variation of it has been applied by auditors for many years. The second one is the statistical rules, which requires the calculation of the standard deviation of the prior year's value. And the last one is pattern analysis, which uses the pattern of fluctuations identified by row 2 to indicate which error, if either, seems likely. The first one is very simple. We can see that the RT here is the value we get, and the R with a cap here is the expected value, which is adjusted by the industry, like that. And we think that if we should also pay attention to the critical value, because it's very important to for this when we try to do the test. Yes, sorry. Because you all remember that like in different ratios, variation is different. The second one is the statistical rules, which is use standard deviation of the audited monthly value for the previous audited years. And the rule triggers an investigation when the difference between the book value for the test month and the expected audited value is so large in relationship to there is a difference that is unlikely that it's just like coincidence. Here is a formula easier to understand. And the last one is the pattern analysis, which is accrued pattern analysis for monthly cross-sectional of the first three ratios. And we want to compare the combination of signals to investigate from the three ratios. Here is an example of the third rule. We can see that, for example, if we find that there is no increase in receivable turnover, there's no decrease in inventory turnover, and there is no decrease in the cost of sales ratio, then we assume that there is no alert for either error, and we will have a lot in other situations. Yeah, there is summary is that the rule 1 and the rule 2, they are ratios. Population ratios is a ratio, and the third rule is like pattern analysis. The basis is the combination of the first three ratios. Yeah, here is like a test result of this study. We can see that first we can pay attention to the cost of sales ratio here. And we can see that the cost of sales ratio doesn't often change by more than 10%. Yeah, because you can see that when the symbol changes, when it's like 0.05, it's like only 5, and when it's 0.1, it's raised up to 39. The ratio other than the cost of sales ratio shows the poor diagnostic power when we use like row 1. Row 2 may be a little better, but when we can find much more uniform cost ratios reflecting the self-styling features of the row. And the third one, we can also know the number of correct signals, and we can have the ability to investigate what the error type was. When the seeded error is in this part, we want to do a sensitivity analysis of this data, and then we will change the seeded error to 0.5 and 2 to test it, and then we find that when it's 0.5 less than normal, it's increased the type 2 error rate for almost every comparison, and the three ratios are effective in indicating the presence of error. And the second one, the accrual ratio, are ineffective. There is a great decline in correct indications of the seeded error type when there is a 0.5 or 2 times material amount. Of course, all the analysis above is a good method. However, there is risk. So we need to do preliminary explanation analysis. The risk is that the auditor will stop the analytical investigation of an unusual fluctuation before its actual cause has been found. So what we should do is to walk through the account balance implication of the proposed explanation of the deviation, and we should check the deviation of the revised analysis. If we find there are fewer deviation, then we should know that our hypothesis is correct. If it's incorrect, that may adjust accounts that were not in error, or may further adjust accounts where errors already exist. To have a better understanding of this, we can use this as an example. Here is an example that the credit credit purchase of a material amount have been omitted. And we use our experience to find out that lower cost of sales explanations includes omitted purchase, over-counting ending inventory, overpricing ending inventory, and cost reduction due to a new economic order quality or a shift in product mix to goods with an unusual high contribution margin. So if we assume that the reduction in the cost of sales ratio is due to the acquisition and sale of a special line of product, what we should do? What we should do is revise the interest that would have been due to the special acquisition and sale. We should also assume that at month and 3/4 of these special sales have been collected, but none of the liability has been paid. So we will subtract them from ending receivables and payables. After that, we can find the variation, and we can compare them to whether this is real reason or not. Other explanations can be tested in the same way. After we design such analysis, we can know that a preliminary explanation analysis, as discussed above, will not be 100% effective. Of course, some explanations have patterns of contrarianities that are very similar to those of other explanations. Similarly, for some of the months, the analysts will not show less spread with the correct explanation. However, the revised ratio analysis will guard against accepting some explanations, and it's very inexpensive to apply when a computer assisted system is used. The computer assisted pattern analysis help guard against accepting a causal explanations by carrying out this account and their implicities. Okay. Finally, we will give a summary of the limitation and future study of this paper. The reliable attention directing and analytical review procedures requires a fairly large ratio of accounting error signal so we can get rid of the natural variation of the noise. And with the pattern of deviation from the expectation over several related issues may be useful in identifying the cause of the error. And last one is as a preliminary explanation analysis that reverse possible error can be useful in preliminary evaluation of the suggest explanation of the deviation from the expectation. That's all. Thank you. I saw Jamie have a question.
Can you go back one slide to the summary? Any comments, guys? No, summary.
I think that's
Jumi, go ahead. Jumi, you had your hand up, didn't you? What happened? We lost Jumi here?
I think Jumi went to the seminar.
Okay. Okay, so anyone has comments here?
I have a question myself.
Okay.
First, I know that this paper is like 13 years ago, more than 13 years ago. So I saw that when they designed this rule 3, I don't know how they designed this rule. Maybe they just manually designed this. But I think if now we have a big data sample, and if we can even do that on population, and maybe we can use machine learning on this. I mean, we can let machine generate a rule-based like method, not we design it ourselves, because it may not be reliable if we just design it manually.
Okay. Any other comments?
So I feel like to do the audit analytics, the most one of the most important factors is that the auditors know enough information about their client before they develop the models or
Okay, and
Uh,
and Hanchi?
I'm thinking. Uh, uh, I'm not sure. I think. Sorry. Yeah, I think maybe we should have a more detailed look at the method. I mean, how they design the rules, not just like all the details. But yes, I don't know. Professor, do you have any comments?
Sorry, I just want to ask, they design so to assess the auditing quality. So how about the generability of this method? I'm questioning about this.
Yeah. Can you just repeat? I have a difficulty hearing. It got a little blip here in the middle.
Oh, sorry. I think this paper they come up with a method like about using a ratio method to assess the auditing quality. So I
Yes.
question about the durability of this method. So how about apply this method to different industry or different firms with different properties or nature characteristics?
So what do you guys think?
Correct me if I'm wrong, Andrea. So, I think the ratio analysis, the three methods that the author presented are actually quite common in the audit planning, right? So at least from what I saw, the auditors do this simple comparison and decide whether the change is big enough and decide whether they want to further look at the issue. So, but I agree with Hanshi that these methods might be outdated and we may need new methodologies.
So you say it's outdated. Outdated by, Hanchi said, machine learning, but what would you do here? What would be the method? Meaning, ratio analysis is the only real analysis of analytical nature that is normally performed in audits and is part of the standards, okay, in what I call analytical review. So, which basically shows how remote and how backward are the standards and the profession, and also I think shows that financial statements are not very informative.
Yes, I mean, definitely I've seen that's how the ratios were used, at least when I worked, and that was a while ago. But I mean, the most commonly used method of comparing the calculations to the expectation was like the simplest one, just the deviation from the expected rate, right? So it's the rate you expected. I mean, it's what you found minus what you expected divided by that expectation. That was like the simplest way. But my opinion, that's completely really my opinion. I don't think that analytical procedures should be used for the field work for substantive tests, other than just getting additional comfort or just highlighting areas that you should look further. No matter how precise you do the analytical procedures in this way, without talking about machine learning or any looking at the data any differently than the traditional methods, I don't think it gives that much comfort about the balances. It's more about, do the relationships are as you expect, and if they're not, why, and just look further. I don't think there should be used to propose any sort of adjustment or to adjust the numbers based on those expectations. Going too far, just because we use analytical procedures and the balances are not as we expect them, let's propose some sort of adjustments based on that. Yeah.
Andrea, I actually don't know exactly how this is done in practice. Do you have does the company, the firm, have kind of expected ratios to compare against, or how does they expect an auditor to? I mean, the ratios are required to be used. They are used.
Yeah, I think each firm, especially like the big four, they have their software that provide guidance. So for each engagement, you build the audit based on what the company looks like. But then there are steps that you open. They call them the steps. So you open the step and you see there, okay, perform analytical procedures for the income related balances, and then there's some examples, and then you choose which ones you want to do and then to perform them, and then you have to document why you chose that ratio, why you expected it to be the way you expected it to be. For example, are you basing it on last year's numbers? Why should it be last year's numbers? Are there any other things in the economy or in what the company has experienced that you should expect some deviations from that? Then you're supposed to explain why you set that, what kind of threshold you set. If your calculations are different from what you're expected, how different can you tolerate it to be? And then you have to show your calculations. And if you have found any differences, you have to document what you have done to investigate those differences, if you are satisfied with what you've done, and all that. And all of that, when the auditor is performing those, they are completed, and then they're sent to a reviewer, which is a supervisor of the engagement. They look at it, and if they're not satisfied, they should be looking into further. But it's a little bit. There are some standards and there's some guidance, but then of course it's the judgment of the person who's performing it and then the person who's reviewing it. But there are some examples of what could be good ratios in certain situations, certain industries, and for certain balances and all that.
Okay, I know a big problem we have in academia is that we have a big difficulty on getting ratios that are per industry or per sector. I sent you a paper just now, I sent it to Abby to send it to you. And it's a paper by Kexing Xuan, and I don't know if you already covered in class. I don't think we did, or afterwards we have it. And this paper basically uses clustering to create better industries for ratio analysis. The other problem that you have, so the comparisons are different. The other problem you have is that the data we get from CompuStat is typically consolidated data, and so it's very difficult to compare a company that is 50% medical, 50% financial, with a company that's just financial. So that I always say consolidation is obfuscation. And so this paper, we basically create a new indices, and we are trying to work with Deloitte Spain to get sector data from their audits, and they are now kind of getting a little bit better. Maybe they'll get us the data. They are experimenting on it. So ratios are used, but as Andrea explained, they are used in a very wide sense. There is no expert system that examines ratio and calls exceptions on a systematic basis.
Yeah, that's true.
So sorry, I still have a question.
Yes.
When I read this paper, I find that when they select the ratio, they just say that they want to use the ratio that's in the same one particular account because they think that can be more clear. But I think nowadays maybe we don't need to do that because we have multiple ways to, even the ratio is not within one particular account, we can do the analysis. We just need to know the relationship. Right?
If you can write the paper for you in the end of the semester, proposing this idea, I think is a great idea. Idea of multidimensional or multivariate ratios may be contingent to industry and using pure plays. Pure Play is a company that only plays in one industry. Read the Kexing Xuan paper that got published in Horizon. I actually work with them extensively, but as I was the editor, I didn't join the paper. And I think you have a look at that. It would be a tremendous paper that you could write, and probably would be eventually a publishable paper. It's ratios are very how could I say, non-accurate tools. They are very blunt tools as opposed to sharp tools. But they are only one that people really use at this stage. In this call I was having yesterday with Professor Kogan and a couple of other people, we were just talking about that using you basically do a lot of ratios in the risk assessment, and he says maybe before we, and this guy was a developer of the major systems of one of the big four, very experienced system designer and 35 years of audit experience, and he was basically saying that we are really not understanding the risks of companies with the tools we have today. And he doesn't know too much about machine learning, but I could see that that's what he was trying to say. I just didn't open the topic for other reasons.
Can I add a comment here?
Please.
I read a paper recently that's in JAR, which uses raw financial data instead of financial ratios to predict accounting fraud using machine learning methodology. And their conclusion is that in their research, the raw financial data such as revenue and accounts receivable, these raw data actually perform better than using ratios. And then I also adopted similar methodology that I found actually among hundreds of financial ratios used in the existing literature, they can be narrowed, they are actually formed by just less than 30 raw financial information. So the authors, they say the reason why using raw financial information is informative is that if you use machine learning can aggregate or combine the information in the raw data in different ways that fit better to the problem itself, rather than you said, okay, I use this ratio, that ratio. So it's like if you use decision tree or support vector machine, the algorithms can create this quote unquote ratio by itself, but in a better way to solve the problem at hand. So I think I suggest people to read that paper. But it's
Abby, can you send that paper to the class?
Yeah, sure. Yeah.
Okay, Hanshin, can you move to your summary, the final slide you had? Okay, so it basically says reliable attention directed analytical review procedures require oops. Guys, can you hear me?
Yes.
Yeah, because it's telling me that WebEx is updating, so I got a little bit worried here. Reliable test direct analytical review procedures require a fairly large ratio of accounting error to signal. This is a comment I had in many papers that I read. And you know what people do is they seed errors. Seed errors, I really don't like it, although I don't think there is very much alternative to it. The idea is typically the number of companies that are known fraudulent or known discrepant is very small. So it's very unbalanced type of sample. And so what people do in many of these tests, we did it in our MADS project, is stick more errors into there. And of course, in that sense, is really kind of self-fulfilling prophecy. If the error that you seed is very anomalous, it's detected. If it's not very anomalous, won't be detected. And you need some kind of methodology to create likely errors. And don't get Enron and WorldCom as the example because they are very large anomalies. So I have a problem with that seeding errors methodology, and exactly is that if your signal to noise, signal to natural variation of noise is very large, in the error signal, you detect it or not. Okay. And second one, pattern deviation from expectation would be very interesting. And there hasn't been a lot of follow-up on ratio variance that should be very interesting to be performed. And preliminary explanation analysis that reverse possible errors can be useful in, and I totally agree with that comment. I find this a good paper because it really kind of recaps for you what ratio analysis, or if you've never done it, kind of gives you some information about what ratio analysis